All right, ladies and gentlemen, coming to the stage, the moderator of our next panel, Make It a Thriller, Not a Horror, focus on legal, tax, and accounting. Craig Perry is a partner with Parr Brown and has a diverse international business practice, representing clients with business interests throughout Europe, the Middle East, and Southeast Asia, and particularly in Japan. His practice frequently involves matters in the Pacific Rim. He advises and represents numerous Japanese companies doing business in the U.S. and Europe, and also counsels and represents many U.S. companies doing business in Japan, advising them not only on legal, but also cultural issues as well. His practice emphasizes technology, intellectual property, unfair competition, non-compete, and trade secret cases. He advises and assists regional, national, and international clients in developing, obtaining, utilizing, and protecting their IP assets by negotiating and drafting, licensing, distribution, joint venture, acquisition, and other agreements in the U.S. and abroad. Please help me welcome to the stage, Craig Perry.
For all of those who are still here and who make it to the end of the day, they're giving away free iPhone 6s. So stay with it a little bit longer. But there are a number of legal and tax issues and related issues that companies face as they enter foreign markets or they expand within foreign markets. And too often, companies are not aware of these, or they don't know what they don't know until it's too late. They get down the road a few months or a few years and find out that had they made decisions and done planning differently in the beginning, it would have saved them a lot of heartache and headache and expense. Just within the past month, I've had two different companies come to me. One of them expanded into Southeast Asia, started selling in Korea, and selling their product in Korea, and sales took off much more than they had expected, and they found themselves after about 2 years with about $6 million in cash sitting in a Korean bank account with no way to repatriate it here to the US without severe penalties, and finding themselves being audited by both Korean and US tax authorities because they hadn't got the proper agreements and arrangements and pricing in place in the beginning. Another company opened up a manufacturing facility in Mexico to take advantage of some inexpensive labor there. And after a year, they decided to close the facility for business reasons. But at that point, they found out that under Mexican labor law, they were committed to those employees for another 12 months. So they were then faced with either the Hobson choice of paying employees for 12 months who weren't doing any work, or paying a several $100,000 fine to the Mexican government. So these are things, just a couple things that companies ought to be aware of as they're thinking about international operations, and that's what we'd like to address in our panel. So if I could invite the panel members to come forward. Once they do, then I will introduce them. So first, on my immediate right is Al Manbian. He's the managing partner and founding member of GPS Capital Markets, Inc., a leading corporate foreign exchange brokerage firm. His firm has been recognized as one of the fastest growing companies in its region and for having the best practices in its industry. Al has a wealth of experience in various facets of international banking, such as currency and derivative risk management, global treasury processes, and trade finance. Al speaks to these topics at various industry and academic forums throughout the country. He holds a Master's of Business Administration with highest honors from BYU and a Bachelor of Science in International Finance, also from BYU. He currently serves on the Board of Governors of the Salt Lake Chamber of Commerce and on the Board of Directors of the Hill Center Theater. In addition, Al is on the advisory board of BYU's Global Management Center. He is also an adjunct instructor at Salt Lake Community College. So we welcome Al. Seated next to Al is Diane Thompson, who is substituting for her partner Barbara, who is called away on an emergency. Diane is a partner in the national law firm of Ballard Spahr LLP, and the firm serves clients on a broad range of corporate, compliance, tax, and security matters. Ballard Spahr attorneys have extensive experience with domestic and international mergers and acquisitions, joint ventures, strategic alliances, private and public equity and debt offerings, general corporate matters, distribution, agency and licensing matters, and market entry strategies. Diane regularly advises U.S. and foreign clients in connection with the establishment, structuring, tax issues, and compliance related to their international operations. She also advises on the Foreign Corrupt Practices Acts and related training for employees. And finally, on the end, on my far right, we have Chris Fletcher, who's an international tax director with Deloitte Tax LLP. He leads the firm's international tax practice in Utah. Chris has been with Deloitte Tax for 20 years and has experience in serving U.S. and foreign companies with their global tax planning. His expertise includes cross-border structuring, foreign tax credit planning, foreign tax minimization, global financing, intellectual property planning, transfer pricing, and IRS examinations. Chris was part of the firm's National Comprehensive Tax Solutions Group for 5 years and worked with companies across the country on issues related to export sales benefits, expense allocation, income sourcing, and foreign tax credit utilization. Chris has been an instructor on these topics at a number of university and seminars. So I think to get started, we'd just like to introduce a couple ideas on different ways of entering a foreign market and doing business and some of the things to consider, and again, to help us here in the audience understand just a little bit better what we don't know and that what can later hurt us. So maybe we could start with Al, who could give us an overview of different ways to enter into an international transaction or operations.
You know, I think a lot of times maybe some of us enter into the international markets almost by accident, right? Because you get an inquiry, you have a successful product, you have a successful service, and word gets around, and there is an inquiry, and you feel like, well, here's an opportunity for me to expand my market and expand my footprint, and you go into the international market. And when that happens, a lot of times that happens through a direct sales mechanism, a direct outreach, and you establish a relationship and you make a shipment and you are now an international business person. But then the spectrum of how to enter really should be a lot more of a strategic decision, and it depends on a lot of different things. So the very first way I mentioned, that idea of it being direct, you're an exporter without an importer of record, is the accidental way, a lot of ways of how people get in. But then as you take baby steps and think about, well, what other ways can I do this? It's very common for companies to work with international distributors or work with foreign agents that represent their product, their brand, their service, their company in foreign markets. And then as you continue along that spectrum of ways to do business, you can look at joint ventures with partner firms. And then ultimately, it might be appropriate, whether you do this on day one or you do it after a level of success, for you to actually own foreign entities that are your subsidiaries and allow you to further your business objectives overseas. So it really is a combination of strategy and opportunity.
Thank you. You mentioned an initial way of being an exporter, but not the importer of record. Is that something you could speak to, Chris? And what are some of the things one would want to consider? What is that, first of all, and secondly, what are some of the considerations?
Yeah, sure. So an export by definition means that you've got a product crossing a border. And anytime that happens, the government in the country of destination is going to want to know about those goods coming in. And the person bringing those goods in is referred to as the importer of record. And so when that occurs, most governments have requirements, reporting requirements, tax requirements around the importer of record. And so there are different ways you can export. The simplest way is to export and allow your customer to take title or ownership of the goods, either in the US or in international waters, and they become then the importer of record in that destination country. But if your business in that country or that region expands to a point, a lot of times companies will want inventory on the ground to help minimize the shipment time. And so that's when they start crossing over this line and they can become the importer of record. And when that occurs, you need to keep several things in mind. There's always customs duties and registrations and filings around that. You have indirect taxes, such as value-added tax or goods and services tax, which is kind of the foreign version of our U.S. sales tax. And then you've got possible issues around income tax as well. So these are some of the things to keep in mind as you progress along that that export spectrum.
Thank you. And Al, as one might be entering into an agreement or contract for this, what are some of the payment considerations to be kept in mind?
You know, excuse me. There's probably a number of things you need to look at, but I want to highlight two. One is you are the exporter. I imagine the reason you are exporting is so that ultimately you get payment. But structuring that and understanding how to do credit due diligence on a buyer overseas can be a daunting and overwhelming task in of itself. And so the first thing you need to do is, how do I sell? Do I sell by requiring payment up front? Well, that might put me at a competitive disadvantage. But if I don't have payment up front, how can I get some security that I will ultimately receive payment for this contract? And so the marketplace has a number of ways you can do that. One is through just contract structuring. We will do X percentage up front, X percentage after a certain period of time or certain milestones, X percentage at the end of a contract. That's one way you can do it, is by embedding it in the contract and giving yourself some protections. Another way is to take advantage of some banking products that are out there that help you mitigate that payment risk to some degree. So again, if we've got this range of risk from open accounts, where I take all the risk by saying, you know what, I'm going to ship the goods and you pay me in 90 days, and we'll cross our fingers and hope that happens. That's one end of the risk spectrum, right? On the other end of the risk spectrum, you have this idea of, I want 100% of my money up front. Well, in between there, we talked about you can structure a contract and allow for different payment triggers. The other thing you can do is use a banking product that's called a documentary collection, which Chris talked about, title and title documents. You, in essence, use the banking system to transit title documents to the buyer's country, and the buyer cannot receive those title documents, which are what allow them to clear goods from customs, until they pay. And so that's a product called a documentary collection. Or ultimately, the most secure thing you can do short of prepayment is you ask for what commonly in the industry is referred to as a letter of credit. And really, in the simplest term, the way that a letter of credit can be described is that it's a conditional bank guarantee, where a bank tells you as the exporter that should you do certain things according to certain guidelines that are established in the letter of credit itself, it's a document, then if the importer does not pay you, the bank will pay in the place of the importer. So on the payment side, that's the one thing you want to highlight, which is how are you going to structure your terms. The other thing that you have to decide on is traditionally you're going to be dealing with a country that has a different currency. And so you have to decide, what currency is the contract going to be? Is it going to be in the foreign currency, or is it going to be, in this case, in the US dollar? And a lot of time, our defensive mechanism says, I'm going to just structure the contract in US dollars, and therefore I am going to have no currency risk. But that's a false sense of security, because a lot of times if you do that, and some event happens in the foreign country that economically impacts your buyer, whether that's a distributor or an agent, it can impact their ability to pay you back. So a lot of times you see companies say, no, I'm the exporter, I'm going to control it by making the contract be in the local currency, euro, yen, peso, but then I'm going to go and use a financial product to mitigate the risk of the currency fluctuating up and down in the same manner that you might get a mortgage lock on your home mortgage.
Thank you. And it was mentioned earlier, another option for going into a foreign market would be through a third-party distributor or an independent sales agent. Diane, would you mind telling us maybe contrast the two and explain why one might choose that mode of entering a foreign market?
Sure. I think Al made a very good point about we tend to fall back on our own, sort of knowledge, our familiarity with sort of U.S. terminology, U.S. concepts. And one of the key things to remember is that if something acts like a pig, smells like a pig, looks like a pig, it's probably a pig, even though you might call it something else. So when it comes to distributors or agents, it's really most important that you understand what that individual is going to do for you, what you expect of them, that you have clear contract terms, and that you have a good understanding. Distributor typically might mean to someone, well, I'm going to move product to that distributor with or without cash payment, and ultimately the distributor then takes it into the market, and I'm not controlling their activities. So you don't control price necessarily, you don't control the activities of the distributor. You also have no ability to determine if that distributor might be violating federal US laws or foreign laws, but you can protect potentially against some of those risks. On the other hand, an agent could potentially be someone who is your agent and directing, or you're directing, ultimately responsible for their behavior. And to the extent that you do that, then ultimately the company is doing business, in essence, through its agent in that foreign jurisdiction. So that means a whole host of tax issues that, are different questions about whether you're doing business. Do you have a permanent establishment? Do you have to potentially pay local taxes? All the kind of key concepts of doing business may actually creep up on you because you're using an agent instead of a distributor. And very often those terms in the US might mean something to us. We may even actually put them in a contract, using them defined the way we believe them to be defined, but others in other countries may not view those terms in the same way. So it's real important to have a clear understanding between the parties what activities are going to be undertaken, what terminology you're going to use, and then to recheck and make sure, along the way, have some controls and some inquiries that that's actually happening.
Thank you. Chris, do you have any anecdotal stories or instances of this turning poorly for someone that didn't do it right?
A lot of what I do is helping companies clean up, and you will see many companies as they are going international, they'll use an agent. And so that's often one of the early stages of international expansion that you'll see. And so one client came to me and was discussing with me their expansion into Asia Pacific. And they said, yeah, we've engaged this independent contractor, they called him, in Singapore. And we got talking more about it. And they described a scenario where this independent contractor, well, his only source of income was this arrangement with the company. He had a business card that showed the company, my client's name, and they even had him with a title that made him look like he was an employee of the company if he handed out his business card. He was able to go to all these different countries throughout Asia Pacific and negotiate contracts, and worst of all, he was able to sign the contracts. And so what this led to is several exposures. It led to, in a lot of these countries they were selling into, and where he was, negotiating and concluding these contracts, it led to income tax and indirect tax, VAT and GST exposures in those countries, potential filing obligations, for the U.S. entity. The other thing it did for them in Singapore is it also gave rise to some potential payroll withholding exposure and filing obligations there. And so these are some of the things that you have to keep in mind as you're expanding and using these sorts of agency relationships. And these are the sorts of situations that can take what otherwise might have been a great success for the company and really turn it into a very painful experience.
But in contrast, Diane, have you had experience with clients who have done this correctly and the business has flourished as a result of properly arranging one of these agency or distributor relationships?
Right. Yeah, I think oftentimes clients tend to think that they're not really doing business, so they venture, as you said, Al, into things. But those clients who have come to us in the first, sort of emerging stages of the ideas about what they might want to do, and you know, discussed alternatives. We've been able to put contracts in place, have really good discussions, and even participate with them in dialogue with some of these agents and others to be clear about what it is that their expectations are, tend to do the best. And although, you know, that's an investment up front, which a lot of clients don't really want to venture into because they're not sure they're going to recoup that investment, it pays back in spades to avoid some of the issues that you've talked about and some of the other corporate issues that we find part and parcel to those kind of situations.
And just to follow up for Al or Diane or both, what do you see in the current regulatory environment that a company ought to be aware of and ought to ask questions about before venturing out into these foreign transactions?
You know, for my part, I would say you just need to make sure that you know your counterparts. As a participant in the financial industry, what I would tell you is that governments, both U.S. and abroad, are turning to financial intermediaries more and more and saying, tell us about this transaction, tell us about originators, tell us about beneficiaries, tell us about the purpose of funds. And these are things that we in turn will turn to the client and say, well, what do you know about your buyer? What do you know about their shareholders? Because there's this burden on the system that you must know the different parties that touch a transaction from beginning to end. And so I think you just need to understand that beyond just making the business transaction secure, you need to make yourself secure from a due diligence perspective. And then maybe the only other thing to touch on is that in the US, we do have more of a regulatory burden today than we did 5 years ago in terms of what companies can and cannot do in terms of structuring contracts and financial contracts in particular as it relates to Dodd-Frank and some other federal regulations that are out there.
Thanks. And I noticed, Diane, on your resume it mentioned the Foreign Corrupt Practices Act. What would you advise a client to pay attention to there, or what questions to ask in that regard?
Yeah, that's a big issue these days. The Foreign Corrupt Practices Act basically is a regulatory structure that combines sort of the SEC and other federal agencies to try to prevent bribery of foreign officials or U.S. officials or vice versa in business transactions. And it's sort of an expansive movement across the globe for that sort of federal regulation. You see UK regulation that's significant in that area. These are situations where you can prevent liability by having compliance policies and programs, training your employees and others that you interact with, whether they're agents or distributors, about the types of ethical behaviors and legal behaviors that are expected in their interactions with foreign governments. And it's very often the case in other jurisdictions that individuals will be affiliated with governments where you might not otherwise expect that. So, for example, in the context of a medical device industry, often in foreign jurisdictions, the medical system is a socialized system, and so often there's purchasers who are medical device procurement individuals, but they're working for the government, and financial interaction with them, bringing them on trips, paying for expenses, a lot of those types of business development behaviors can inadvertently cause you to violate those acts, resulting in significant penalties, inquiries by the SEC, personal liability. So those are areas to take a look at and make sure that you understand what you're doing and can limit your liability before you go down those paths.
That's a good point. Just in the last few minutes here, let's just touch briefly on sort of the third form of business that was discussed at the outset, if you're ready to jump in the pool instead of just dip your feet in, and that is the joint venture, or a joint business arrangement of sorts. And maybe we'll just start with Al, and if you would explain maybe some of the key aspects of that and the considerations that might lead one to that decision, and then Diane and Chris, if each of you could just from your own practice areas, give a thought or two on the pros and cons or the cautions of that, then I think that would be useful.
Well, you know, joint ventures happen for a myriad of reasons, but in concept it's pretty easy, right? It's the idea that both parties are formally becoming partners in a activity and in an entity and in a purpose, right? And you can do it because each party is bringing some different form of capital. That capital could be intellectual capital, that capital could be financial capital, but each party is bringing capital to the venture. I suppose the second reason is the same line my wife used on me when we were dating, which was, it's a sign of commitment. We need a sign of commitment. So in a very similar manner, as a commitment to a venture, you will see two parties come together, three parties, multiple parties come together and do something together. And maybe a third reason worth mentioning is a lot of times it's brought about by external factors, such as local laws require a local partner in a overseas venture. And so you might go searching for a joint venture partner because the law requires that in order for you to proceed in a given country or in a given region.
Thank you. Diane?
Yeah, I think you know, my comment on that would be careful who you get in bed or the boat with, because they may not have an oar, and if they don't, you know, you're going to be in trouble. So know who your partners are, have clear contracts, responsibilities and roles set out so that you know which venture is doing what. Do some diligence on their practices and behaviors and ethical requirements and procedures and those types of things. Don't assume that your venture capital partner or your partner in a business transaction is going to take care of some aspect of it, because that assumption could potentially get you into trouble. You know, have written agreements, be very clear about who does what. You know, if you're in concern about something, form joint committees so that you do have a voice and a view on particular aspects of the transaction. And you know, I think caution and clarity up front usually is a much better practice there.
Thank you.
Yeah, on the tax side, your structure in the U.S. and whatever form or structure you set up in the JV, in the foreign market, the way those interact can have a number of different consequences in terms of impact to the shareholders, especially in a closely held situation, if it's flowing through. There are very specific considerations in terms of, you know, loss utilization and utilization of foreign taxes as credits in the U.S. that you want to keep in mind. And so you want to look at these things up front and make sure you're thinking through it logically and with the right advisors. I'm dealing with clients right now who didn't do that, and they're losing out on millions of dollars in credits and loss utilization as a result of not thinking ahead about some of these issues and really choosing carefully how they're structuring these things. You never want the tax tail wagging the dog, but once you've got your business imperatives set, you want to step back and try and plan ahead and wrap those tax consequences around the joint venture structure.
I think Chris makes a good point, and that was what we hoped would be a simple takeaway from this. We can't possibly hope in 25 minutes to educate you on all the pitfalls and potential areas of advantage and disadvantage to going international, but what we would caution is to say, ask the questions up front. Think of these things in advance. Talk to advisors, professionals. It's an old and tried saying, but you know, an ounce of prevention's worth a pound of cure. It's a lot less expensive to do it right in the first place than to jump in and then ask questions later. We have about 2.5 minutes left. Do you have any final comments or thoughts you'd like to share? We'll just go down the row.
I think I would just echo what you said, and a lot of times the way I phrase it is I say expand globally, because, you know, my livelihood depends on it. But as you do so, please make sure that you're managing risk, and then after that you're managing risk, and thirdly that you manage risk.
I agreed. I second that. I think the other way to manage risk is to make sure your advisors are talking to each other with you so that you're getting consolidated, cohesive advice. You're not being told one thing from one set of advisors and something else from others. We're all happy to chat with each other and support each other because these are complex areas. No one advisor can know it all, and we all know what we know and what we don't know. It's much better for our clients if we're all talking to each other.
Thank you. Chris?
Yeah, I completely agree. The other element I'd throw into it is you can have the best product or service in the world, but if you don't have the right local resources, and I mean across the board, your advisors certainly are a critical element of that, but you need to make sure you got the right local resources from a government contacts perspective, from a partner or distributor perspective, an employee perspective, whatever it might be, and that you're bringing all the right local resources together, and that can make all the difference in the world between success and failure.
Thank you. Well, we thank you for your attention. We'd like to thank the panelists and hope you enjoy the rest of the program today.